You're watching gold hit record highs while your savings account loses value every single day. And I need to tell you something that most financial advisors won't admit. We're at a turning point that only happens once or twice in a lifetime. Right now, gold just shattered through $4,400 per ounce. That's not a typo. $4,400. And here's what nobody's talking about. This isn't the top. This is just the beginning of something much bigger. Let me show you what's really happening behind the scenes because the mainstream media is completely missing the story. While they're focused on stock market headlines and cryptocurrency drama, the world's most powerful institutions are quietly making the biggest bet of the century. And they're betting on gold. Central banks just purchased 800 metric tons of gold. That's $105 billion worth in a single year. Think about that number for a second. These aren't retail investors panic buying coins. These are the people who control entire economies, who have access to every piece of financial data imaginable, who employ armies of analysts. And they're converting their reserves into physical gold at a pace we've never seen before. But here's where it gets interesting. This isn't random. This is coordinated. And it's happening for a reason that goes far deeper than inflation or market volatility. The BRICS nations, Brazil, Russia, India, China, and South Africa, are systematically moving away from the US dollar. Not slowly, not gradually, aggressively. They're building an alternative financial system, and gold is at the center of it. Now I know what you're thinking. You've heard about de-dollarization before. It's been talked about for years. But something changed. Something fundamental shifted in the global financial architecture, and most people completely missed it. Let me paint you a picture of what's actually happening in the gold market right now, because this is where your life savings come into play. Imagine you're at an auction. There's a rare painting on the block. But here's the twist. The auction house has sold 100 certificates claiming ownership of that same painting. Everyone thinks they own it. Everyone thinks they can claim it whenever they want. But there's only one actual painting. That's the gold market. The paper gold market, the futures contracts, the ETFs, the certificates, represents claims on far more gold than actually exists in deliverable form. It's a system built on the assumption that most people will never actually ask for physical delivery. But what happens when they do? We're starting to find out. And it's not pretty for anyone holding paper claims. The COMEX, that's the major commodities exchange where gold futures trade, is showing signs of stress that veteran traders haven't seen in decades. The amount of gold available for delivery keeps shrinking while the number of contracts keeps growing. It's like a game of musical chairs, and the music is about to stop. Here's a specific example that should terrify anyone who thinks their gold ETF is as good as physical gold. A major European bank recently tried to take delivery of physical gold from their COMEX contracts. Standard procedure happens all the time. Except this time, they were told there would be a delay. Then another delay. Then they were offered a cash settlement instead. Think about what that means. The exchange that's supposed to be backed by physical gold couldn't deliver physical gold. They offered paper money instead. That's like going to your bank to withdraw your savings and being told, "Sorry, we don't have your money, but here's an IOU." This is happening while gold is hitting record highs. Imagine what happens when the real squeeze begins. Now let me take you back to 1971 for a moment, because history doesn't repeat, but it sure does rhyme. That's the year Nixon closed the gold window. He ended the convertibility of dollars into gold. And you know what happened next? Gold went from $35 an ounce to $850 by 1980. That's a 2,400% increase. But here's what most people don't know about that period. It wasn't a straight line up. There were moments of doubt, moments where it looked like gold had topped out. In 1974, gold dropped from $200 to $100. Everyone said the gold bull market was over. The experts called it a bubble that had burst. Then it went to $850. The people who sold in 1974 watched from the sidelines as gold multiplied 8 more times. They listened to the experts, they trusted the conventional wisdom, and they missed the biggest wealth transfer of that generation. We're in a similar moment right now. Gold has had an incredible run. It's up significantly from its previous highs. And I guarantee you, there are experts right now saying it's overvalued, it's due for a correction, it's time to take profits. But those experts aren't looking at what the central banks are doing. They're not looking at the structural changes in the global monetary system. They're looking at charts and historical averages and traditional valuation metrics, and they're missing the forest for the trees. Let me tell you about something called the gold to M2 ratio. M2 is a measure of the money supply, basically how many dollars exist in the system. Throughout history, There's been a relationship between the amount of money in circulation and the price of gold. Right now, that ratio is completely out of whack. Based on the current money supply, gold should be trading at over $7,000 per ounce just to match historical averages, not peak ratios, average ratios. That means even at $4,400, gold is still undervalued by almost 60% compared to the amount of currency that's been created. But it gets better, or worse depending on your perspective. The money supply is still growing. Every time there's a crisis, every time there's a bailout, every time the government needs to fund a new program, more money gets created. And every dollar that gets created makes existing dollars worth less. Your savings account isn't growing. It's shrinking in real terms. The number might go up slightly with interest, but the purchasing power is evaporating. Gold doesn't have that problem. You can't print more gold. You can't create it out of thin air. It has to be mined, refined, and physically delivered. And mining production has been flat for years, while demand is exploding. Speaking of demand, let me tell you about what's happening in Asia, because this is where the real story is unfolding. China has been accumulating gold for years, but they've been quiet about it. They don't announce their purchases in real time like Western central banks. They update their official reserves occasionally, and every time they do, the numbers are shocking. But here's what's really interesting. China's official reserves are almost certainly understated, by a lot. Independent analysts who track import data, mining production, and refinery activity estimate that China has accumulated far more gold than they've officially reported. Why would they do that? Why hide their gold purchases? Because they're building a position. They're accumulating while prices are still relatively low. And when they're ready, when they've accumulated enough, they'll reveal their true holdings. And the market will have to reprice gold based on that new reality. India is doing something similar. Indian households have always loved gold. It's part of the culture. But now, the Indian government is actively encouraging gold accumulation as a strategic reserve. They're making it easier to buy, easier to store, easier to use as collateral. Russia has been even more aggressive. They've been converting their dollar reserves into gold for years. They saw the writing on the wall after Western sanctions. They realized that dollars held in Western banks could be frozen, could be seized, could be weaponized. But gold held in Moscow, that's theirs. Nobody can take it. Nobody can freeze it. Nobody can sanction it. This is the new reality of global finance. Gold isn't just a hedge against inflation anymore. It's a hedge against financial warfare. It's a hedge against currency manipulation. It's a hedge against the entire dollar-based system. And here's where it affects you directly. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the markets. The dollar's dominance is being challenged in ways that seemed impossible just a few years ago. Saudi Arabia is now accepting yuan for oil payments. That's huge. The petrodollar system, the arrangement where oil is priced and traded in dollars, has been a cornerstone of dollar dominance for 50 years. When that system breaks down, when oil can be bought in other currencies, the demand for dollars drops. And when demand for dollars drops, the value of dollars drops. And when the value of dollars drops, the price of everything priced in dollars, including gold, goes up. But it's not just oil. Trade agreements are being rewritten. Currency swap lines are being established. Alternative payment systems are being built. The BRICS nations are creating their own development bank, their own payment infrastructure, their own reserve currency system. And at the center of all of it is gold. Now, I want to address something that I hear all the time. People say, but gold doesn't pay interest. It doesn't generate cash flow. It just sits there. That's true. Gold doesn't pay dividends. It doesn't pay interest. But you know what else doesn't pay interest? The cash in your savings account. After you account for inflation. In fact, it pays negative real interest. You're losing purchasing power every single day. Gold preserves purchasing power. That's its job. That's what it's done for 5,000 years. Every paper currency in history has eventually gone to zero, every single one. But gold is still here, still valuable, still recognized as money everywhere in the world. Let me give you a concrete example. In 1971, the average house in America cost about $25,000. That same house today costs about $400,000. Did houses become 16 times more valuable? No. Dollars became 16 times less valuable. But you know what's interesting? In 1971, you could buy that $25,000 house with about 700 ounces of gold. Today, you can still buy that $400,000 house with about 90 ounces of gold. Gold preserved purchasing power. Dollars didn't. That's the difference. That's why central banks hold gold. That's why the wealthy have always held gold. Not to get rich, to stay rich, to preserve what they have across generations, across currency crises, across political upheavals. And right now, we're entering a period where that preservation is going to matter more than ever. The debt levels in Western economies are unsustainable. Everyone knows it. Nobody wants to talk about it. The U.S. national debt is over $35 trillion. That's trillion with a T. The interest payments alone are becoming one of the largest line items in the federal budget. There are only 3 ways to deal with that much debt. You can pay it back through austerity and economic growth. You can default on it. Or you can inflate it away. Guess which option governments always choose? They inflate. They print money. They devalue the currency. Because it's the politically easiest path. Nobody has to vote for spending cuts. Nobody has to raise taxes explicitly. The inflation tax is invisible to most people until it's too late. And that's exactly what's happening right now. The money supply has exploded. Government spending is at levels we've never seen outside of major wars, and the currency is being debased in real time. Gold is responding exactly as it should. It's repricing to reflect the new monetary reality. And we're still in the early stages. Let me show you what the technical picture looks like, because this is important for understanding where we're headed next. Gold broke out of a multi-year consolidation pattern. That's significant. When an asset consolidates for years and then breaks out, it typically runs much further than people expect. The consolidation builds up energy, like a coiled spring. And when it releases, the move is explosive. We're seeing that explosion now. But here's what the charts are telling us. There's very little resistance above current levels. Gold is in price discovery mode. It's making new all-time highs with no overhead supply to slow it down. The next major psychological level is $5,000. That's where you'll see some profit-taking, some hesitation. But based on the momentum, based on the fundamental drivers, based on what central banks are doing, $5,000 is just a pit stop on the way to much higher levels. Some analysts are talking about $7,000. Some are talking about $10,000. And you know what? Based on the money supply, based on the debt levels, based on the structural changes in the global monetary system, those numbers aren't crazy. They're actually conservative. But here's what you need to understand. This isn't about trying to time the perfect entry point. This isn't about waiting for a pullback that might never come. This is about recognizing a fundamental shift in the financial system and positioning yourself accordingly. The people who waited for a pullback in the 1970s missed most of the move. The people who waited for gold to get cheap again watched it go from $200 to $850 without them. They were waiting for the perfect moment while the opportunity passed them by. I'm not saying gold won't have corrections. It will. Every bull market has corrections. But trying to time those corrections is a fool's game. The risk of being out of the market during a major move-up is far greater than the risk of buying before a minor pullback. And make no mistake, we're in a major move-up. This isn't a trade. This isn't a short-term speculation. This is a multi-year, possibly multi-decade shift in how the world values money and stores wealth. Let me tell you about what happened in 2008, because there are parallels to today that are impossible to ignore. When the financial crisis hit, gold initially dropped. People needed cash. They sold everything, including gold. It went from $1,000 down to $700 in a matter of months, and everyone said the gold bull market was over. Then something interesting happened. As the Fed started printing money to bail out the banks, as governments around the world launched massive stimulus programs, gold started climbing, and it didn't stop until it hit $1,900 in 2011. The people who sold in panic at $700 missed a 170% gain. The people who bought during the panic made fortunes. We're in a similar setup now, except the monetary stimulus is even larger. The debt levels are even higher. The systemic risks are even greater. And gold is responding accordingly. But here's the crucial difference between now and 2008. Back then, it was primarily Western investors buying gold as a hedge. Now it's entire nations, it's central banks, it's sovereign wealth funds. It's institutional money on a scale we've never seen before. That's a completely different dynamic. Retail investors can panic and sell. Central banks don't panic. They accumulate strategically over years. They're not trying to make a quick profit. They're repositioning their reserves for a new monetary era. And when central banks are buying, you want to be buying alongside them. They have information you don't have. They have resources you don't have. They have time horizons measured in decades, not quarters. Follow the smart money. And right now, the smart money is buying gold. Let me address another concern I hear frequently. People say, what if the government confiscates gold like they did in 1933? It's a valid concern. FDR did issue Executive Order 6102, which required Americans to turn in their gold. But here's the context that matters. First, that happened during the Great Depression when the U.S. was on a gold standard. The government needed gold to back the currency. We're not on a gold standard anymore. The dollar is purely fiat. There's no operational reason for the government to confiscate gold today. Second, even if they tried, the logistics would be impossible. In 1933, most gold was held in large bars by banks and wealthy individuals. Today, gold ownership is distributed among millions of people in coins, small bars, jewelry, and ETFs. How would they even track it all? Third, and most importantly, gold confiscation would be political suicide in today's environment. The backlash would be immediate and severe. It's just not realistic. But let's say I'm wrong. Let's say they do try to confiscate gold. You know what that would signal? It would signal that the monetary system is in complete collapse. It would signal that the government is desperate. And it would cause gold prices to skyrocket on the black market, just like they did after 1933. So even in the worst-case scenario, gold ownership would be valuable. It might be illegal, but it would be valuable, just like it was in every other country that tried to ban gold ownership. The point is, the risk of not owning gold is far greater than the risk of owning it. The risk of watching your savings evaporate through inflation is real and happening right now. The risk of a theoretical future confiscation is speculative and unlikely. Now, let's talk about what's happening in the physical gold market, because this is where things get really interesting. Premiums on physical gold, the amount you pay above the spot price, have been rising. That's unusual during a bull market. Normally, when prices are rising, premiums shrink because supply increases to meet demand. But that's not happening now. Why? Because there's a shortage of physical gold, not a shortage of paper gold, not a shortage of gold futures contracts, a shortage of actual physical deliverable gold. Refineries are running at full capacity. Mints are struggling to keep up with demand. Dealers are reporting delays in getting inventory, and premiums keep rising. This is the early stage of what could become a full-blown physical shortage. And when that happens, when people start demanding physical delivery en masse, the paper gold market is going to break. Imagine you're holding a futures contract that says you own gold, but when you try to take delivery, you're told there's a 6-month wait, or you're offered a cash settlement instead. What do you think happens to the price of physical gold in that scenario? It goes parabolic, because suddenly everyone realizes that paper claims aren't the same as physical metal, and everyone rushes to get physical while they still can. We saw a preview of this during the pandemic. When lockdowns hit, refineries shut down, transportation stopped, and the physical gold market seized up. Premiums spiked to 10%, 15%, even 20% over spot in some cases. People were paying huge premiums just to get their hands on physical metal. That was a temporary disruption. What's happening now is structural. It's not going away, and it's going to get worse before it gets better. The smart money understands this. That's why central banks are taking physical delivery. That's why wealthy families are moving gold into private vaults. That's why there's a boom in secure storage facilities around the world. They're not buying paper gold, they're buying physical gold, and they're taking possession of it because they understand that in a crisis, possession is everything. Let me tell you a story about what happened in Cyprus in 2013. The banks failed. The government imposed capital controls. People couldn't access their money. ATMs were limited to tiny daily withdrawals. Bank accounts were frozen. But you know what still worked? Gold. People who had physical gold could trade it for goods and services. They could exchange it for cash on the black market. They had liquidity when the banking system had none. That's the insurance value of gold. It's not just about price appreciation. It's about having an asset that works when everything else fails. It's about having money that's yours, that can't be frozen, that can't be seized, that can't be devalued by a central bank decision. And we're heading into a period where that insurance is going to be more valuable than ever. The global financial system is more interconnected and more fragile than it's ever been. A crisis in one country can spread to the entire world in hours. We saw it in 2008 We saw it in 2020, and we're going to see it again. When that happens, when the next crisis hits, gold is going to be the asset everyone wants. Not stocks, not bonds, not even cash. Gold. Because gold is the ultimate safe haven. It's the asset that survived every crisis in human history. It's the asset that central banks turn to when everything else fails. And right now, before the crisis hits, is when you want to be accumulating it, not after, when premiums are sky high and availability is scarce. Now, while you still can get it at reasonable prices, let me give you some perspective on where we are in this cycle. Gold bottomed in 2015 at around $1,050. It consolidated for years, building a base. Then it broke out in 2019 and has been in a bull market ever since. But here's the thing about gold bull markets. They typically last 8 to 10 years. We're only about 6 years into this one. If history is any guide, we've got several more years of gains ahead of us. And the gains in the later stages of a gold bull market are typically the largest. That's when the mainstream catches on. That's when retail investors pile in. That's when you see the parabolic moves that make headlines. We're not there yet. We're still in the phase where most people are skeptical, where financial advisors are still recommending a small allocation to gold, where the mainstream media is still questioning whether gold is a good investment. That's actually bullish, because it means we're not in a bubble yet. Bubbles happen when everyone is bullish, when taxi drivers are giving gold tips, when your neighbor is bragging about their gold profits. We're nowhere near that level of euphoria, which means there's still plenty of room to run. Now, I want to talk about something that most people don't consider: the opportunity cost of not owning gold. Let's say gold goes to $7,000 over the next few years. That's a 60% gain from current levels. Not guaranteed, but certainly possible based on the fundamentals. If you don't own any gold, you miss that entire gain. Your portfolio stays flat in real terms while gold owners see significant appreciation. That's opportunity cost. But it's worse than that. Because while you're not participating in gold's gains, you're likely holding assets that are going to underperform. Bonds are getting crushed by inflation. Stocks are overvalued by historical measures. Cash is losing purchasing power every day. So it's not just that you miss the gains in gold, it's that you're actively losing money in other assets while gold is protecting and growing wealth. That's the real cost of not owning gold. It's not just what you don't make. It's what you lose while you're sitting on the sidelines. And here's the thing that keeps me up at night. We're in uncharted territory with monetary policy. The amount of money that's been created, the level of debt that's been accumulated, the distortions in financial markets. We've never seen anything like this before. Nobody knows exactly how this ends, but history gives us clues. And every time in history when governments have printed money on this scale, when debt has reached these levels, when currencies have been debased this aggressively, the result has been the same: currency collapse, inflation, and a flight to hard assets like gold. It's not a question of if, it's a question of when and how severe. The people who are prepared, who own physical gold, who have positioned themselves for this outcome, are going to preserve their wealth. The people who aren't prepared are going to watch their savings evaporate. I'm not trying to scare you. I'm trying to wake you up to reality. The signs are everywhere. The central banks are telling you what's coming through their actions. The gold price is telling you what's coming through its relentless rise. The question is, are you listening? Because this is the turning point. This is the moment where you decide whether you're going to protect your life savings or hope that everything works out fine. Hope is not a strategy. Hope doesn't preserve wealth. Action does. And the action you need to take is simple. Own gold. Not paper gold, not gold stocks, not gold ETFs. Physical gold that you can hold in your hand or store in a secure vault. Gold that's yours, that can't be confiscated by a broker, that can't be frozen by a bank, that can't be devalued by a government. The window is still open. You can still get physical gold at reasonable premiums. You can still position yourself before the real crisis hits. But that window is closing. Every day, more people wake up to what's happening. Every day, more investors move into gold. Every day, the physical shortage gets worse. And every day, the price goes higher. Don't be the person who looks back in 5 years and says, I knew I should have bought gold when it was $4,400. Be the person who took action, who protected their family, who preserved their wealth. Because this isn't just about making money. This is about survival. Financial survival in a world where the rules are changing, where the old certainties no longer apply, where the monetary system is being rebuilt from the ground up. Gold is your anchor in that storm. It's your insurance policy. It's your ticket to financial security in an increasingly insecure world. The turning point is here. The question is, which side of it are you going to be on?